Okay, here we have a very good example in BTC USDT. USD. I don't know why I keep on saying USDT. Okay, let's observe what took place at this particular level. Okay, here we don't have a very big or massive movement away from this order block. Okay, but let's just explore and so that you get the understanding. Maybe we'll be in a position to get another good example. So we have this order block that is on this particular level. Why am I picking this order block? Because it resulted with this lower low, lower high, and the lower low, and we had this level. So with this order block that we have on this particular level here, we see that the last bullish candle. So if you take your Fibonacci and you stretch it from this low to this level, we can see that all those other red candles that are there are not valid. So we're now talking about a bullish order block. So the last down candle or the last red candle before the price start to move up is what we refer to as our order block. So we can see how was I able to pick this as a valid order block. One, we can see at this particular level that this order block resulted in a change of character. One, and we can see from that particular, so that was the criteria that I used to select that order block. So if you mark this candle, I normally want to do the correct thing. If you mark these candles, this one, the body of this candle here, what do you see? You would see that price came to this order block. There was no displacement. That's why I didn't want to use this one. It doesn't carry everything that I want to see. It doesn't carry all the things that I want to see. Okay, let's look for another example. So the problem is this: when you start using order blocks, you would end up looking at every thing as an order block. You think that this one is an order block, but I'm teaching you guys how you can select the best order blocks to use when trading. This is why people say, this concept doesn't work. This concept, it's not. It'll be because you are not following the whole thing. Let's look for another example. If I can't find it, I'll quickly go to MT5 to sorry. I'll quickly go to. Let me just allow those who want to join. Okay, let's go to our booming crash. Okay, we have an example here. Price was coming down, and when it reached this level, it started to move up. But from this particular level here, if you observe what took place here, this is a daily time frame. So now we don't have a replay mode. Okay, let's just do this. We want to identify what was taking place at this particular level. And we said if the displacement or the movement, we have this down candle. We have this bearish, the last bearish candle before a big movement from that level, which signifies that there was the involvement of what smart money traders. And we can see that when that took place, price then went upwards. And we said when you measure the size of your when you measure the size of your when you measure the size of the candle, the size of the candle, the movement must be at least 2 to 3 times as it moves upwards. We can see that's the displacements that we are looking for. It signifies that there was the involvement of smart money traders. Like here, this big candle here, price all along was moving downwards, and here it moved a little bit, and then it started to move upwards. But we can see that from this particular level, there were very big candles. These big candles are signifying that there is the involvement or the presence of smart money traders. So as retail traders, we can't see this. We only see these big candles. And we see that at this particular level, this down candle, the people who were able to, or the participants who were able to cause this big movement are only smart money traders. So one, you have noticed that with this big movement that is taking place, there is the involvement of what? Smart money traders. So you then have to wait. You wait for price to retrace and come back to this order block. So what you would normally see is this. At this particular level, I think that's one point that I forgot to mention. Why is it we buy here and we are targeting at this particular level? We are targeting at this particular level. Why? Because at this particular level, we have external range liquidity. And this external range liquidity is in the form of buy stops. Buy stops. Some people would place buy stops at this particular level, so that if the price breaks out from this level, they will be automatically in. So you want to take advantage of those people who have placed those buy orders, because every time when you're buying, there's someone who should be selling. So when you buy at this particular level, you want to sell here when you close your trade. Why are you selling at this particular level? Because there is buy side.
Welcome to DC Trading. In this quick guide, I'll show you how to download free trading robots, EAs, and indicators directly from our website using your mobile phone. Step 1. Access the website. First, open your browser and type www.dcfxtrading.com, or simply click the link below to go straight to our homepage. Step 2. Navigate to the menu. Once you're on the homepage, look at the top right corner of the screen. You'll see 3 small lines. Tap on them to access the menu. Step 3. Choose your product. From the menu, click on Products. Scroll down the list and select the EA or indicator you want to download. Tap on the product to see more details. Step 4. Add to cart and checkout. Scroll down to read how the product works. If you like it, click on Add to cart, then tap on Checkout. Step 5. Place order and download. Once on the checkout page, click Place an order. After that, tap Download, and you're all set. You can now start using your free EA or indicator. Thank you for choosing DC Trading. Visit our website to explore more free tools to boost your trading journey.
Liquidity at this particular level. So there's external range liquidity in two forms. One, it can be in the buy orders, here, and it can also be in the form of what? Sell stops. Sell your stop losses, because when people are selling and the price is moving downwards, they place their stop losses here. Those stop losses, they are liquidity. So the external range liquidity that is lying above this previous high is in the form of external range. It's in the form of one, buy stops and also stop loss, as people were selling as the price was coming downwards. So that's the reason why you're targeting this particular area. So when price come back, return to this particular order block, you want to enter the market at this level, and your target will be basically this recent swing high. And I've explained why price you want to sell when price reaches this particular level. And when price now move downward, it is coming to grab what we call internal range liquidity. The internal range liquidity is in two forms. We have fair value gaps and order blocks. Those are what marks our internal range liquidity. And you normally see that in whenever price is moving, it is always grabbing external and internal range liquidity. After grabbing external, for example, here we can see price was able to grab the external range liquidity that was lying above this previous or this old high. They call it this one, they call it an old high. And then when price grabbed that external range liquidity, price had to come back to this particular level. When price came back to this particular level, what do we see? There was also a big movement here. If you observe what took place at this particular level, the last down candle was this candle. The last down candle, as the price made this big movement again. You mark it. Why are you marking it? We can see there was also the presence of smart money traders or large institutional traders. Why? Because they were able to cause this big movement that took place at this particular level. You mark it, and we can see after grabbing external range liquidity, price came down. When it came down, it came to this order block that we had here, this particular level. So if you go on YouTube, it's a little bit confused. When I started learning about smart money traders, smart money concept, I was confused. Some people say you mark the body. Some people will say you mark the whole candle. But what ICT teaches is this: you only consider the body, the open and the close of the candle, because he believes that the wicks are shadows. And secondly, the wicks can be used for what? For fair value gap. So in this example, we are only considering what? The body of the candle. And we can see after grabbing external range liquidity, the price came back to grab internal range liquidity in the form of this order block. And we can see this last bearish candle is our bullish order block. We use it to buy. So we're going to place your buy limit at this particular level, and you can see price just kept and just tip a little bit here, and then it started to move upwards. So basically, this is the concept that is there when you're using order block. So some people will consider this one rather than this first one. But I've explained why this one can be an order block. It is not only the fact that there must be a break of structure or what. It is because of how the price moved from this particular level. We said if price can move at least if you measure this size of this candle, it is 2 to 3 times the size of this displacement that took place at this particular level. You know that that particular level, when price returned to that level, price will then bounce and move upwards. And I explained why is it price will always come back to an order block, so that the remaining orders that were not executed when price moved upwards, when price was making this movement, can be executed. So with that 1 million, all the orders, the first order, the 500,000 were executed here, and the other 500 were then taken at this particular level. What are these smart money traders trying to do? They are trying to buy at low price. They don't want to buy at high price, and the low prices are offered when price is in the discount. So that's what we talked about. Want to buy when price is in the discount. Why? Because in most cases, in those scenario, price will be lower. So you want to buy lower and sell high. So that's the whole concept about smart money concept. They want to buy when the price is low. Even if you are running a business, you buy and sell. You want to buy when the price is low and sell when the price is high. So that's the concept that is there even on the PDRA. So I've talked about a lot of things. One, the PDRA. We have a topic in our mentorship which is totally separate that focuses on the PDRA. What do we prioritize when we are looking at this institutional reference point? Because an order block is a institutional reference point that we can use to take our trades using smart money concept. But we also have a fair value gap. So which one? And we also have different types of order blocks. We have in what a rejection block, a breaker block, a mitigation block, primary impulse, midpoint pivot, order block. All those different types of order blocks. And recently, I think implied. He was talking about this implied order block, ICT. We have a lot of order blocks that we have. So which one should you consider when prices manage to come to your discount or premium? So we have a separate topic that will be talking about that, and we also have a topic where we'll be teaching about external and internal range liquidity. But if you have someone who can quickly learn fast, you can be in a position to understand the movement that I was talking at this particular level. So let me just quickly look at another example where we had a bullish order block being where it was in news. Let's quickly look at a bullish order block. So at this particular level, we can see here, you're marking your order block here. And when this retracement took place, price didn't come back to this order block. Why was that? Because price was now in a what? If you measure this one, it's something that you need to learn now when we're talking about the PDRA. Price was now in the discount. In the discount, we give priority first to fair value gap. There was a fair value gap. So price didn't use the order block here, but it used this fair value gap. If you measure from the top part of this bullish candle and the low of this one, we have a fair value. So these are complex issues that we tackle in our mentorship program, where we'll be talking about the PDRA. So price gave priority to the fair value gap rather than the order block. So these are the things that you now be learning when we're now talking about this thing. But still on our order block theory, okay, we have here, let's look for more opportunities. Want to look for another buying opportunity, and then we discuss, then we call it a day. Which one should we talk about? Here we don't have. So what you would normally see is this. Now that you understand what I was talking about, there's something that I need to share with you. Still on that bullish order block, you have price moving up, coming downwards. We have this structure, and this is an uptrend, and price is breaking the structure to create new higher highs, and then price will come back to create a lower a higher low, and then price will break up the structure. So this structure that we have is an example of a bullish trend. So what you would normally see is this in this order block theory. Theoretically, this is what I'm trying to teach here. We have here price breaking the structure. We have a BOS here, BOS here. And when price moved upwards and was able to break this structure and created a new structure, this big movement, this impulsive movement, can only be the result of large institutional traders. It can only be the result of large institutional traders. So that's one thing that you know. Then after that, what do you see? So the last down candle, or the last red candle before the price start to move down upwards, the last red candle, which will be here, the last red candle, this one, before the price starts to move upwards, is what we refer to as our order block. So what you do is this: you mark the body from the top. Okay, you mark the body. So I don't want to use the rectangle when I'm marking my order blocks, although most people are now used to do that. So what you would normally see is this: price will normally, after grabbing external range liquidity. Where is this external range liquidity? There was liquidity that was residing above this higher high in the form of buy stops as the price was buy stops, and also stop loss as the price was coming downwards. And then price then moved upwards to grab external range liquidity. So we talked about external range liquidity. And then why is it price is now coming back to this order block? Because not all of the orders as this impulsive move was made were executed. So that means there were some orders that were left. And these smart money traders, they want to buy when the price is low. So they would wait for price to come back to these lower prices where we have this order block. And then here, that's where you execute your trade, and price will then move upwards. So basically, theoretically, we're trying to say this is what we call a bullish order block. And in most cases, price will continue to move like this. So if you can understand this, you'll be good to go. So the last red candle before the price starts to move upwards is what we call a bullish order block. Okay, let's quickly look for an example. Let's quickly look for an example. The last one, then we call it a day. I want an example, a bullish order block. Bullish. Normally selling bearish, price is moving up. Let me quickly go to the 4-hour chart. 4-hour, why am I going to go now? So you can use this knowledge to trade your synthetic indices. In volatility jump, these assets, when you use your smart money concept, I'm telling you, you can be in a position to make a lot of money. And if you join our mentorship program, there's a way that we can use to for us to get confirmation before we take our trades. There are different ways to execute when you're using order blocks. So this is what I teach in my mentorship program. So now I just want to look for one example, then we call it a day. Yes. So what we can see here, the last bearish candle before the price starts to make this green candle was this one. So here there's a confusion. We have this one and this one is our order blocks, and also this one. This is what you are going to be faced with. You can see here, yes, the price was able to what? To break the structure. We have a BOS here. Okay, let's just say a change of character. Since the price was moving down, we had a change of character. Why? Because we had the BOS, we had the break of structure here. So for you to know that this is a change of character, there must be a break of structure. So here we have a change of character. So here at this particular level, we have a change of character. Here, change of character. So here, the last red candle before the price starts to move up is our order block. So is it this one? Is it this one? Or is it this one? We have 3 red candle. So which one is the last? So if you can observe here carefully, this one is already, here we don't have, although one we have a change of character. But which one becomes the valid order block? Here, if you observe here, we don't have a fair value gap. Why? If you have 1, 2, 3, these candles are trading through each other. They are connected. This last bearish candle and the second bullish candle and the next bullish candle, they are connected to each other. So price will never return to that particular level. Why? Because price is balanced. So we take out this one. Price is already, we can say it is a mitigated order block, or price will never basically come to that particular level. Why? Because there's no fair value gap. Then let's observe here. On this one, we have this bearish candle, bullish, bullish. Do we have a fair value gap? We can see clearly that price is connected. These 3 candles are connected. The high of this candle and the low of this candle are connected. So this one, we don't have a fair value gap. A fair value gap just basically represents an imbalance. So if there is no imbalance, there is no reason why price would return to that particular level. Okay, let's look at this one, which is the last red candle before price starts to move upwards, and it resulted in a change of character. If you look closely at this one, we have this first, it looks like a doji candle, the high of this candle, and the low of the third candle. So we have 1, 2, 3 candles. We have 1, 2, 3 candles. If you observe carefully, we can see that they are not connected together. This high of this doji candle and this low of this candle are not connected. There's a big gap. So this qualifies this last bearish candle to be our valid order block because of what I've just explained. This fair value gap, this order block, this bearish candle is our valid order block. Why? Because there's a fair value gap close to it. This is the gap. Yeah, I'll change the color. Okay. Okay, there's a fair value gap. So an order block is valid when there is a fair value gap close to it. And we can see there was a big movement. So you are just waiting patiently. So someone would say, why is this one not, this one should be an order block? Why? Because it's the last bullish candle that we have, the last bearish candle. This one is not a valid order block. Why? Because if you use our PDRA, if you use our Fibonacci here, we stretch it from where the trend moved and to the high of that movement. We can see price is still within the premium territory. So this one becomes an invalid order block. Why? Because we can't buy when price is in premium. We need to buy when price is in the discount. And this one becomes a valid order block. And we can see why this one was a valid order block. Price, when it made a retracement, it came straight to this order block, and immediately price was rejected and closed above the order block. And from there onwards, what do we see? We see price moving away from the order block. And for our target, it was going to be the recent swing high, which was going to be this particular level. And from there, what do we see? We see price hitting our target. So this is how easy it is. It is to trade using order blocks. So for today's lesson, I think I'm done. I'm done. So I'm just gonna open for questions, maybe for the next 10 minutes. You can unmute and we can you can ask questions. So you're free to unmute if you have a question, and then you can ask. Um, yes, Mr. Bose, how are you? Is it Gab? Is it? Oh, Godwin, how are you? Yes, how are you, sir? Okay, thank you so much, bro.
So the question is, can we look for that same order block in 15 minutes and 1 hour?
Yes.
Because I realize that you've done it in a 4 hour time frame.
Yes, whatever that we're learning about today, like what I said, it's fractal. What it means is this: it can be applied to any time frame. With me, when I'm trading using order blocks, and I've identified my order blocks, I even go as lower as the 1 minute to identify my order blocks, and I trade them on the 1 hour. There were some videos that I used to post, and most people were confused. Although my account was growing up, but there were some comments that were there. People were saying we don't understand this. It was because I was using the same concept, trading volatility indices, but on lower time frames, be it the 5 minute time frame, be it the 1 minute time frame, because there will be quick movement. So that means if you have your $10 or your $5, you can use this same concept, but on lower time frame, because there will be quick movement, price will tend to move very fast, and you will not be in a very huge loss. So you can also use it on the 15 or the 1 hour time frame. You're welcome, sir.